Wunderschönen guten Morgen, wonderful good morning, good afternoon, and thank you for joining us for SF Online session 11 already. My name is Kai Hoffman, and I'm the CEO here of the Soar Financial Group, and I'm extremely excited to welcome you to this session. Brian, thank you so much for joining us. Thanks for coming on.
Thanks for having me, Kai.
Oh, a pleasure. Really looking forward to your presentation, Gold to Contrarian Investment at 1857 gold. I was just checking. How contrarian are we? I'm looking forward to it.
Yeah,
Thanks so much.
thanks. Hi, guys. So my presentation, Gold to Contrarian Investment, question mark. Presentation agenda. I'm going to present 5 ways I think you can be more successful and a consistent investor. Of course, I'm going to go over my thesis for gold and why I think it's a contrarian investment. Then I'm going to give you 3 factors I use to pick exploration companies, and I'm going to finish it off with 2 company picks. It's with mixed feelings. Like one of the first things that happened to me as an investor in the junior resource sector is I doubled on my first investment. And really, I view it as kind of a positive and a negative. It was great to make money. But on the other side of things, I think it made me more confident than I should have been to begin with. And Rick Rule has that great quote of confusing a bull market with brains. And I definitely would have done that right at the beginning. Second to that, I made a huge jump in my investing career in 2016. I left a career in steel manufacturing to become an investor full time. When I did that, I was relying heavily on the income generated by my investments. And as such, I had to come up with a process to make myself more consistent and manage emotion in what is definitely an emotional laden career as an investor. So these are 5 ways I think that any average investor can be more successful and consistent. So the first one, self-awareness. The junior resource sector is a tough niche part of the market because you have to have knowledge in a variety of different aspects or factors. You've got geology, mining methods, mineral processing and metallurgy, capital markets, accounting. Each of these components would make a good investor in the junior resource sector. Of course, especially at the beginning, none of us have an in-depth knowledge of these topics. And of course, you need to educate yourself as best you can, reading books, watching videos. There's a ton of good stuff on YouTube. And then, of course, some people will have some strengths and maybe it's individual components of that. And I think if you do have a strength before you're going to enter the market, you should play to it. If you're good at looking at balance sheets, that's where you should start. And the second point I read on there is never stop learning. Like I've had success in the junior resource sector, but for me, the process of learning never stops. I'm constantly reading and trying to up my knowledge, especially on those things that, I was never formally trained in, and geology being a big one. Second is my risk profile. I think everybody needs to ask themselves the question, how much risk am I willing to take in the market? Another big point is, have you lost money before? And that might sound kind of funny, but I think it's a question that a lot of people ask themselves, and they say, you know what? Yeah, I'm comfortable with losing 50 or 60% of my investment dollars. But then it happens. And then you realize that most people probably aren't going to be that comfortable losing the money. I'm speaking from experience. I thought I was probably more comfortable with losing money than I actually am. I really don't like it. And therefore, I try to protect my downside risk at all costs. So I think it's something that you're going to learn over time, but you do need to ask yourself and, invest accordingly. What's the duration of the investment? When you go to pick a company, you're going to have an investment thesis. And you're going to say, there's a bunch of catalysts that the company's going to complete, and if successful, this is how the share price is going to hopefully go, and it's going to take 6 months to a year. Then
Brian, sorry, got to jump in real quick. Your slides are unfortunately not updating on the screen that you're sharing. So we're seeing your power. There's still the first slide on the screen, unfortunately, so we can't follow along.
Okay. Can you see now?
There we go. It's on slide number 5. Yeah, now it's updated.
Okay, sorry.
You might have to do that continuously. Sorry about that. Sorry for jumping in.
Yeah, no problem. So what's the duration of the investment? So you put together a thesis and you say that it's going to take 6 months to a year. And especially with the junior companies, I think one of the things I've definitely learned is that duration of investment can be a hard one to pick because there's things that pop up, and let alone like living in a COVID world. There's other things like backups of the assay labs. Things happen with the management team. Someone gets sick, blah, blah, blah. What I'm trying to say is there's a lot of delays that can happen. And unfortunately, some people can get impatient and they can pick the right companies, but their impatience leads them to sell and potentially lose money because they sold too early. So I think that, patience is a big thing, but the other side to it is if you are thinking more like a trader and you want to be in and out of companies weekly or monthly or quarterly, then maybe you need to find companies that suit the way you want to trade. Maybe it's the bigger companies that have quarterly financials and such. Maybe this is where you want to be. But the point is you need to align yourself with what you're investing in. And the last point, how much time will I dedicate to due diligence? This is a big point. I would say for most the average retail investors in the junior resource sector, this isn't your full-time job. And as such, I think that you don't want to over leverage yourself in terms of the companies that you put into your portfolio and track. You put all that time in to find the right companies, you invest your money, which is a huge chunk of time. But then you also have to follow these companies, track the news, and make decisions based on that news flow. So in my view, I think you're still better to look at a smaller, more concentrated portfolio, but it also depends on your risk factor, your risk profile, and such.
Brian, just real quick again, we're still on price to value ratio, unfortunately, on your slide there.
Oh, okay.
It's not. So it's showing us the main the main PowerPoint app or application there.
Okay.
It's not flipping through for some reason.
Would it be? Can you see my screen here?
Yeah, I can see the screen. Yeah.
So maybe I'll just flip through like this.
If that works, yeah. If that works for you. Okay, perfect. Okay. Yeah. Thank you.
Okay. So number 2, price to value ratio. If I were to pick a point that I think that investors could improve the most by, it would be working with the price to value ratio. At conferences or via emails or Zooms that I've done with readers and different investors, people want to tell me a lot of qualitative components of why I should invest in their favorite junior company. And the qualitative points are very important, and they're definitely part of the investment thesis. But in my view, it starts with the quantitative analysis. What is the company worth? You must be able to quantify the value of a company and be able to compare it to its market cap. And there's 2 main components there. You're going to look at the balance sheet, and then you're also going to do a discounted cash flow model yourself. And from here, you should be able to tag a value on that company. And then, of course, you're looking, at least I would hope you're looking for companies that are selling for less than they're worth. Paying a premium or paying what a company is worth doesn't typically give you a lot of room to be right. And in the junior resource sector, with the cyclicality and the sentiment swings that we see, I think you want to be on the value side of things. Buying something that's less than it's worth, or buying something that's cheaper than it's worth. And then you also have to be able to look at that discount and say, is it appropriate? Some companies are selling at a discount, and they should be, and they probably always will be. And obviously, these are the companies you want to avoid. You want to be looking for the companies that are selling for less than they're worth, and have an action plan to have that value recognized by the market. And you're going to judge that discount with a number of factors. You look at the management, the jurisdiction, the metal price, their ability to raise cash, share structure, balance sheet. All these things kind of play into what kind of discount is appropriate for that particular company. Number 3, markets are impossible to predict. And this is a point where I think that, many investors, especially newbies to the sector, make mistakes. So the first point is, if you're bullish on a metal, buy the metal. And to me, it's very different than investing in a junior resource company. So first, with the metals markets, I think it's really difficult to consistently predict the direction of a metal price. It's so complex. It's a global market, both on the supply and demand side. You have these data points, there's hidden inventories. And I think that people tend to underestimate the efficiency of markets, meaning that what high metal prices actually does and how it brings, production, whether it's an old mine that they bring back into production, or, new mines that are put into production quickly. The market is incredibly efficient. On the other side, the junior resource companies, there's a plethora of other risk factors that go into a junior resource company. In my view, you don't invest in a junior, or the number one reason you invest in a junior company shouldn't be because you're bullish on the metal price. And I think that's where the mistake is typically made. I outlined some of those risk factors in the last point, and all those still apply to a junior company and how they can lose you money regardless of where the metal price is going. And then I end off with, there's a quote by Nassim Taleb: why is the theory never right? Because we'll never know if all the swans are white. And in terms of this point, I'm trying to say, don't be too set in your view on really anything. There's always something that can come up and change, and it can change on a dime. So just keep an open mind. Number 4, sell price. To me, selling at the right price is as important as buying at the right price. Bottom line is, you need an exit strategy to take profits and de-risk your investment. Over the course of my investing career, this is one of the most important things I've learned, and it's really the last major thing that I've learned in the last couple of years, how important it is to sell and de-risk your investment. You need to learn how to do that. Number 5, rules to invest by. As I stated at the beginning, when I left my career in steel to be an investor full time, I had to have a process to go, lean on, so that I can manage my emotions and then operate consistently in the market. And I was tracking I have tracked all my trades inside a journal that I keep beside my desk. And I look at, what's making me successful, and of course, what's making me unsuccessful. And from that, I've developed, a set of rules, again, that it's laid out on a piece of paper beside my desk. And it has, 10 or 15 rules that I keep me bound into the companies that I invest by. And, especially for a newbie investor, I think this is a great way to be more consistent and successful in the junior resource sector. So some potential rules that you could use. I only invest in royalty companies. This is related to your risk profile. Or each company can only represent a maximum of 10% of your portfolio. Again, another risk element that you put in there. I only invest in companies with projects in North America. Insiders must own at least 5% of the company. So these type of rules keep you bound. And, there's so many more rules that you can set up for yourself, but you look at those rules every time you're going to make a decision in the market. So moving on, what's the best contrarian opportunity in the market? In my view right now, it's gold. And it feels kind of odd to me to say that gold's a contrarian investment. To me, the reasons for owning gold and, the gold miners is so clear. To me, especially what's happened in the last couple of years highlights the reasons why gold needs to be part of a portfolio. But unfortunately, the market, doesn't necessarily see it that way, or see it that clearly right now. And, you see especially with the miners' valuations, we're sitting at some incredible values there. There's a lot of value in the market. So what are some of those factors that the market might be looking at so that they, disagree right now, at least with me? So negative factors affecting the gold price. I think there's 3 areas. We've got a threat of interest rate hikes in 2022. We've got Bitcoin and crypto, and then we've got the strong performance of the broader market. So number 1, interest rate hikes. The US Fed has hinted at interest rate hikes in 2022 to quell inflation. We just had the January year over year numbers released last week, and it was 7.5%. The 7.5% is a CPI number. And in my view, I think the CPI number is a terrible number, the way that statistic has been constructed. And really, I would say the real inflation is probably actually much higher. The market expects to see a 0.25% to 0.5% rate hike in March. And we've already seen the broader market start to sell off in anticipation of this. With interest rate hikes, typically what we see is a stronger US dollar. And for those that have covered or looked at gold, in previous years, usually the relationship between the US dollar and gold is inverse, meaning a strong US dollar is usually met with, a weak gold price, and vice versa. But right now, it's actually kind of an interesting spot we're in, where potentially we're going to see a stronger US dollar. It's definitely being hinted at. Yet the gold price has stayed, relatively strong at 1,800, and then we saw this breakout in the last week or so. And it's not a huge breakout yet, but it's quite interesting that's showing that strength. In my view, I think their interest rate hike is going to be short-lived. I think there's too much debt in the public and private sector, and I think the market is going to continue to sell off, in anticipation or as a result of these interest rate hikes. And so, to me, it's just a matter of time before these things need to be reversed or they're put on hold. And I think that's when the market really will wake up to the importance of gold in a portfolio. Number two, Bitcoin and crypto. I think without a doubt, Bitcoin has, siphoned some of the attention away from would-be gold investors over the last year and a half. The returns are phenomenal, and there's a huge amount of marketing being done to promote it, and they've done exceptionally well. The other side is the world is digitizing. Crypto is where fiat money is headed. And I think, especially the younger generation probably sees this and is maybe more interested in it. And that's why, we've seen so much strength in Bitcoin. The other side to that, in my view, gold is real money, and I don't think that changes moving forward. It's got stable price action. And I think the most important point to make, in terms of the physical metal is that it's tangible. In a digitized world, physical money out of the system, I think, is an absolute must in everyone's portfolio. And unfortunately, I think more people are going to be scrambling for gold at that point when they realize how important it is to have that physical metal out of the system. But we'll see how that goes. Number three, we have broader market performance. And so I have a chart of the New York Stock Exchange. You can see the strength out of the March 2020 lows. Typically, strength in the broader market means that you've got, probably a weaker or maybe horizontal moving gold price. Gold is typically thought of as maybe the fear trade. The people move their money out of the stock exchange or the broader market and put it into gold because they have some negative sentiment or whatever about what's going on in the world. Obviously, a strong broader market, I think, leads to lower interest in gold. But that's obviously, I think, changing, and one of the reasons why we've seen some more stability in the gold price over the last, let's say, month. The other side to it is it's skewed valuations across the broader market. And I use Tesla as an example. Tesla has a market cap near $1 trillion or over $1 trillion, depending on what it's trading at. The big three, Ford, GM, and Daimler Chrysler, they have a combined market cap of, let's say, 250 billion. There's clearly a misrepresentation of value here, in my view, anyways. And I think that this, where we're kind of headed with the market, this could be the one of the things that starts to unwind, and it can unwind quite quickly, considering the discrepancy there, between car companies, and that's just one example. Yeah. So how to profit from investment in gold? So I think there's two main ways. I think first and foremost, you buy the physical metal. It's real money and it's insurance against financial calamity. And really, I say profit, but really the gold is exactly how I just described it. It is real money and it's insurance against financial calamity. Making money off gold is, you mixed feelings about that, because a higher gold price, of course, means that more chaos is probably happening in the world. So, there's a little bit of trepidation when I say to profit from gold, because it's a double-edged sword. The second is to invest and speculate in the miners. And there's a spectrum of risk across the types of companies that you can buy. On the lower risk, lower maybe technical knowledge, you have the producers and royalty companies. And to me, I think, if you've got a keen eye for balance sheet analysis, I think you can really be successful in this part of the types of companies. Then you have the mid-risk, mid-technical knowledge, and this is really developers. These types of companies usually have a 43-101 resource or an economic study. And then you have the high risk, high technical knowledge explorers. There's no resource for these companies. Usually there's little to no drilling, and the odds are unfortunately against you. So I think you need to buy a basket of these types of companies if you want to be successful. So looking at exploration, exploration is the sexiest, probably part of the junior resource sector. You can see huge gains relatively quickly. You can also lose a ton of money very quickly. And invariably, whether people should or shouldn't, they usually have a couple explorers in their portfolio. So I thought I would give a few points on how I pick exploration companies. So the first and foremost, number one, you want to look at the people. People should always be your first consideration in the junior resource sector. But this is even more so, I think, with exploration companies, because essentially the value in an exploration company is its people and their experience and acumen for exploring. You want to look for people with a history of success. They've made a discovery, they've applied their technical knowledge, and it's resulted in a discovery. They have a systematic approach. They're able to explain why they took a project, what steps they're going to take to outline targets, or how they're going to get or make a discovery. And then another point is technical acumen fits the type of exploration. This is a really important point. In tier one jurisdictions, most of the outcropping, easy to find deposits, they've mostly been found. Companies are having to look underneath cover to find, the next gold deposit, for instance. And one of the ways that they do that is till sampling. But till sampling is intricate work. Yeah, you need to have the right people to take, handle, and examine the samples. And an example of the right people doing that sort of work is a company called Overburden Drilling Management. Again, this stuff is super intricate, and you need the right people to look at it so that you're spending money correctly and you're getting to the right conclusions. And then the final point is access to capital. Money follows success. Usually the good exploration companies are going to have a roster of good strategic shareholders. Second, we have the project. Good people choose good projects. So if you choose wisely in number one, usually the project is going to come in line. But let's take a look at, the project in terms of grassroots exploration, the stuff I look at. So I look for large land packages, 10,000 plus hectares. That's a good amount of land. Good geology, they're exploring the right age of rocks, high alteration, structures, big, deep tapping faults, and proximity to other large, mineral systems are important points. Little to no drilling on the project. And then if they have targets, I like to see big geochemical anomalies is preferable for me. The project should be located in a jurisdiction that matches, management's experience. If you're going to go into some of the more far-flung places in the world, I think you want to look for management teams that have been there and done that. They've shown the ability to attain and maintain social license. I think it's so important these days. And then the last point comes to do with reducing risk or exploration risk. And this is one way you can look for companies to lower this is the prospector generator model, where they JV their projects out. They lose some of that upside, but the most important point in my view is they reduce the downside. And personally, in the junior stock premium portfolio, we've got a couple companies that employ the hybrid model. And I think it's a really good way to explore. And the final point, share structure and low G&A. When you find good people, you want to get in as early as possible. Look for share structures, under 100 million shares is a good place to be. And then the last point on G&A, you want to find companies with reasonable G&A. The vast majority of the money has to be put in the ground, especially when you're exploring. So onto the company picks. This is a company that I think fits my points for exploration to a T. Contrarian Minerals is a top-notch explorer. It's got a market cap around 30 million. Great team of people, high technical acumen led by CEO Zach Flood. The strategic shareholders, management insiders own more than 50% of the company. The top 10 shareholders own 64% of the company. And some of those big individual shareholders are John Toganetti, Paul Stevens, Peter Meredith. Great roster of strategic shareholders. Tight share structure, under 60 million shares out. And another big point is they've successfully applied their exploration process and made a discovery. They've got a joint venture project with Sumitomo in Frotet, and they made the Renault discovery, which was 29 meters of 8.5 grams per ton gold. Great discovery, and that since that discovery, they've completed a couple phases in the drill program. They're currently on phase 3, and they're stepping out along strike and at depth on the R1 and R2 structures. And I think that we're going to see some great things come out of this. They have a suite of projects in Canada and the US, and this is mainly Quebec, Ontario, and Alaska. And they employ the hybrid prospect generator model. And they've got some of the best JV partners in the business, Sumitomo, Newmont, and then most recently Barrick. Next, we have Montage Gold. Montage has a market cap around 70 million. The company's led by CEO Hugh Stewart. Hugh's got over 25 years of experience in the business. He's been a part of or led the teams that have discovered over 30 million ounces in Africa. The biggest point on that 30 million ounces is the vast majority of those ounces are actually in production. And I think that's a big point. Some strategic shareholders in Montage. We have Orca Gold, Lundin Family Trust, Sandstorm, and then of course management. We've got a tight share structure, around 100 million shares, roughly 10 million in cash. Koné just released their feasibility study this morning or on Monday. And at the current gold price, we see great NPV, after-tax NPV around $1 billion. So I think there's plenty of upside potential here. And the production profile, 15 years at over 200,000 ounces is exceptionally good. And they're a top takeover candidate for sure in my mind. And the exploration upside, the Petit Yao, they've already encountered mineralization that's up to 3 and 4 times the grade at Koné. And if they're able to, delineate a couple of satellite deposits here and feed it into the operating mill early on in the mine life, I think it's a big deal and it'd be a boon to the NPV. The last point, be picky, always be picky. I write Junior Stratigraphy Premium. You can find more of Premium on juniorstratigraphy.com. And of course, email at juniorstratigraphy@gmail.com anytime. Thank you very much.
Fantastic, Brian. Great presentation. I really appreciated it, especially that you closed off with a couple of your top picks as well, just to sort of solidify the thought process behind what you had mentioned before, because I fully agree. Like, I've been to the Frotet project with Ken Arland. Great group. I think we're going to have Zach Flood here in the office, like for an SF Live interview very soon as well. Great. So I can fully attest to that. Unfortunately, we're out of time, Brian, but okay, please stay on for a bit longer, so we can have some questions going on in the chat. Sure. Sollten Sie Fragen an Brian haben, bitte packen Sie die in den Chat oder in die Q&A-Funktion hier. Können wir dann direkt beantworten. He will type the questions out in the chat. Unfortunately, we have to move on in the program. As you know, we're German and we go right on time. Brian, thank you so much for joining us. It was a great pleasure seeing you again. It's been too long.